Share my screen. All right, what's up, everybody? Mokama Sunday service. Today, we're mostly going to be talking about the September pullback, as my daughter is starting up in the background. Um, um, so, once again, for everyone out there on YouTube, this is for informational purposes only. Trading, investing is risky. Uh, Consult your financial advisors regarding all your trading and investing decisions, and do your own research. Right. So, with that said, we're talking about the September pullback. We've talked the last couple of weeks. DeAndre, you were missing last week, but the week before I talked about it. I was actually waiting for a little short pop in the market, specifically on the NASDAQ up to 20,000. We didn't get anywhere there. Literally, like the minute the market opened September 1st, we just started heading down. It was expected. So let this be a reminder, if you hold positions before September, even August, and you're just swinging something, you get out of your position before September happens, or at least be prepared to get out or have a tight stop um, for a potential September pullback, because traditionally this is the worst month for the market. And for your long-term positions, like, some people are quick to sell their long-term positions, but if you're expecting a pullback like I was, it's easier to stomach a correction or a pullback without, selling stocks when they're down and then they pop back up and then you miss the move. If you believe in your stocks, you believe in and what you're trading and the companies that you're trading, you should be expecting pullbacks in August, but specifically September. So, like, for me, that's helping me stomach the drawdown in my account. I was up maybe like 25% on the year, and then the last couple of days, I'm down to 6%, right? But we're still up on the year, and I believe that I bought some things at levels that I liked. Some have pulled back even further than what the technicals would have potentially suggest, specifically on ASML. Nvidia, not so much. Nvidia has been holding at that level above 100. And what else in my account? Google, that's a leap that I had, but I have a ton of unrealized gains there, so I can stomach a pullback. My option expiration on that is not till June of 2025. They have some antitrust concerns and things of that nature. Shopify pullback. Pretty much the whole market. If you looked at the market on Friday, everything across the board was down, with the exception of maybe like 3 or 4 stocks. So, like, there really weren't too many places to hide on Friday in general. But this is the September correction that we typically go through. October is usually like a consolidation type of month, and then we're usually off to the races in November and December in terms of seasonality on average, right? In terms of probability. So, and we're still in an election year. The market tends to run in an election year, so that's why I intend to hold on to most of all of my positions. I might cut ASML, but I already think it's at a level where it's bottomed. I could be wrong. So for me, like, I should have sold at around the price that I got in if I wanted to sell. But once again, it's September. Pullbacks are to be expected. So, I'm holding my stocks right now, at least until the end of September. And then one thing, I was listening to this podcast. It's called Chat with Traders. I believe it was Chat with Traders. And he was crunching some data as well. And not only is September typically bad, the latter half of September is typically worse. So I'm kind of, once again, I'm looking for a pop in the market for a good place to short. I don't just like shorting because it's September 1st. I usually like to see some level reach where it's likely going to be exhausted to the upside before I short the market. And I didn't really find a good position, a good risk reward position to do that for this particular pullback. So I'm hoping this next week or the week after we get a pop back up, and then I'll probably look to short again at a major level if we get some sort of bounce back over this next week or two. All right, let me get out of here. So let's talk about next week. What do we have coming up? It's always good to look at some of the economic news that's coming up. Last week, the main number that we saw was the employment report on Friday. And this is another reason potentially that the market could have came down on Monday, other than it's just September. We were expecting an addition of 161,000 jobs, and we only got 142,000 jobs, which isn't good for the economy. And I feel like we are finally getting to a point now that we know that the Fed is going to start lowering interest rates. At least the probability is really high because job data is coming in weaker than normal, and inflation numbers have been pretty tame recently. So it seems that the Fed is going to start lowering interest rates relatively soon. So we might be getting to a point where bad news is actually bad news and good news is actually good news. Recently, we've been at a point where good news is bad news, where the employment report shows we added more jobs than what the expected number, then the market would go down because they believe the Fed is going to hold interest rates steady instead of cutting them. But now that we're in a position where the Fed has been hinting and kind of specifically saying that they're getting ready to start cutting interest rates at this next meeting that's coming up within the next week or so, then we already kind of have that priced in. So now if we get bad jobs data, then that might actually be bad news for the market. And so we see the jobs numbers came in a little bit weaker than what was expected, but the unemployment rate held steady, right? It was expected to be 4.2%, and it came in at 4.2% in line. So this is what I'm saying. It may just be seasonality in terms of just our September correction that we typically have. If you go look at the episode from last week, I showed you the last 5 Septembers. Only one in the last 5 Septembers has been positive. So, expect a drawdown in September. If you're having a swing trade on at the end of August, think about closing that out before September, right? And then if we're looking at earnings next week, another good thing to go look at. Last week we had Broadcom's earnings, which is in the chip sector, and it didn't do so well. In fact, let me go show you. AVGO is Broadcom. I'm on a month chart. Go to a day chart. Right. So you see they had this gap down after their earnings. That did not help the chip sector at all in terms of NVIDIA, ASML. I didn't check AMD, but I assume AMD was down. Yep, it was. TSM was also down on Friday. So Broadcom reporting less than stellar earnings didn't help the entire chip market on Friday, right? And this is another thing where you could see, like, if one particular name might affect an entire sector in terms of what the outlook for the sector is. So some names can trade down in sympathy. So, like, while I might not trade Broadcom this day because I hate trading stocks or instruments on during their earnings period, you could go check out something in sympathy like AMD that's probably going to move along with it. That might be a little bit more stable. Same thing, TSM, right? Might be a little bit more stable. Even, what did NVIDIA do on Friday? NVIDIA, same thing. You see all the chip stocks looked almost exactly the same on Friday. All had red candles. The entire sector was down. Not just that, though. The entire market, we look at the market. It's the NASDAQ. NASDAQ was down. And see, and just to give you some perspective, right? Our August pullback was actually worse than where we are right now. So, yes, we've pulled back. The market has come down. But that wicked pullback in August, like from mid-July all the way to the end of August, that was way worse than what we currently have. Now, I'm not saying we can't keep going down next week or the end of September, but we still haven't hit the level and the depths of where we were in that August correction that we had. You can see we pop back up, but we have a lower high, which is not looking good for the technicals, right? But what I don't want to see from a technical standpoint, I don't want to see the NASDAQ get lower than this low right here. If we get lower than this low, then that's what's going to cause me to have some worry, maybe start cutting or trimming a position or two. That's not so great, but I don't want to see the NASDAQ get below this low, which is around 339 approximately. The actual low is 17,351. It looks like on this candle, right? I don't want to see us get lower than that. If we do get lower than that, then it might be cause for concern. Same thing here on the Dow. This low of this candle is 38,541. I don't want to see us get lower than that because I don't want to see us making lower lows. You see the Dow, though, has been the strongest because it made a new high right here, which is always good to be making new highs rather than making lower lows, right? So Dow is probably the strongest. ES is pretty strong too, but the ES is usually a combination of the Dow and the NASDAQ, right? The ES is not the captain of its own ship because there's like a mixture of the Dow and NASDAQ, but still, you see our August correction is so far where we haven't hit the level of our August correction, but I don't want to see the ES or the S&P 500 get below 5120, right? Especially like 5100, right? Hush, Mamba, hush. And then the Russell, the last major engine, same thing. The Russell actually looks pretty weak as well. It looks as weak as the NASDAQ. So the weakest two indexes are the Russell, small caps, and tech right now. I don't want to see this get below this low, which is what, 1992.8, right down here. If I see this head below there, then I get a little bit worried, right? From a technical standpoint, just reading the technicals, right? We don't want to be making newer low, especially when we had such a huge correction in these like 3 days in August, right? At the beginning of August. All right, let's go back to earnings. So for this week, what we got, Oracle. Oracle's a big company. Would I call Oracle a chip company? No, I would call Oracle like a business enterprise services. They're the type of company where if you need a one-stop server like solution, you'd go to Oracle, right? Huge company though, right? $393 billion company. And I've been trying to this is what I was looking at earlier in the year, but Oracle's a decent company, right? GameStop, that's your meme stock earnings. I never trade GameStop or AMC or anything like that, but some people do. They are reporting on Tuesday. Wednesday, nothing huge. Thursday, you got Adobe, right? That'll kind of show you what the AI trade is doing because Adobe, personally, I love Adobe. I use a bunch of Adobe products. I do Adobe tutorials on Premiere Pro. I use Adobe Lightroom. I use Adobe Acrobat. I use Adobe Photoshop and Media Encoder, and After Effects. I use 5 or 6 Adobe programs because I shoot videos, I edit videos, and photos and things of that nature. So personally, this is a stock I'd be interested in if it pulls back to the right place. And I just see what they're doing with all of their AI tech. So now it's so much easier to edit a podcast on Adobe using text-based editing, where if you throw the video in there, it'll read the script of or transcribe the script of the video, and then you can just kind of chop words, which will chop the video with it, and it just makes editing so much quicker. And this ain't a commercial for Adobe, but it's sped up my editing by 50-60% for podcasts being able to just edit based upon the words rather than having to look at the video and find out where you said this or that. Especially if you have like an hour-long podcast or a 30-minute long podcast, it's a lot easier with the text-based editing and all of these AI tools that they're integrating. And then in Photoshop and all of these other places where you could take an image that you shot, like I filmed a DJ Quick concert last night and took a bunch of photos where I could maybe put DJ Quick on stage with one of my photos and then tell the AI to put a bear in the photo or a tiger or whatever, There's just so many different things that you could do now. And it's like relatively easy. And then really nothing on Friday, right? So we go back to our economic calendar. We got some inflation data. Oh no, that was last week. My bad. Hold on. On Monday, nothing crazy. Wednesday, we got CPI, which is inflation data that I feel is becoming increasingly less important because the Fed has already indicated that they're going to start cutting interest rates. So before we were looking at these numbers to try and figure out whether or not the Fed was going to start cutting interest rates, which is good for stocks. But now I feel like that is already priced in to a certain extent. So unless these come way out of whack, out of expectations, same thing with PPI, unless those are way out of whack, I don't expect them to really affect the job or the stock market as much. What we're more concerned about right now is jobs and how much the Fed is going to cut. Are they going to cut a quarter point, or they're going to cut 2 quarter points or 0.5, right? And then that would be even more bullish for the market if they cut deeper and faster. Not just the market, but like if you're trying to buy a house, like, interest rates are way higher than they've been over the last 2, 3, 4 years, right? So if you're trying to buy a house, like these interest rates coming down and coming down faster are just going to spur more economic activity because it's just going to be easier to borrow currency to purchase things, right? So the consumer, credit card debt, in terms of rates are going to go down. Bank loan rates are going to go down. So that's what we need to kind of spur some more economic activity. And what the Fed's been trying to do over the last year or two has been slowing down economic activity because inflation was running rampant. So now it seems like they've succeeded in bringing down inflation, but they need to start cutting interest rates again before they break something in the economy, right? Lower interest rates means cash is easier to obtain and it's easier to grow your business if cash is cheaper. All right, bam. So where am I looking next week? If we're looking at our month to date, the only thing that has been strong in the first week has been XLP. Same old same if you've been like following me, right? That's the only thing that is above positive territory for the month of September, and then real estate, right? What I would prefer in a September environment is actually a short, right? Because look at everything that has been negative in September. Every sector except for consumer staples has been negative. Even utilities, which has been largely positive over the last 30 days, right? So what am I trying to short? What's the weakest? Chips. So if we get a pop on chips in September, I probably will look to short that. Metals and mining, oil services, oil and gas, tech have all been, which is why I said I want to pop on the NASDAQ so I could short the NASDAQ. I was waiting for a short at 20,000 and we never got there on the first day of September. We were head down. We were headed straight down, so I never got the pop that I wanted to try and short it. But those are the places that I'm probably trying to short. Is going to be energy, chips, energy, tech, right? And this is just the first few days of September, but if we go to last 30 days, oil services has been weak, metals, oil and gas, energy, and chips. So yeah, chips and energy are probably on the highest on my list to short. and tech if we bounce up to a certain level. But if you still look at the last 30 days, the most, and I lost on a couple of trades on financials last week because it kept pulling back a little further than I expected. But financials have been strong. So if I'm looking for day trades, swing trades, last 30 days, I love staples because it's the only thing that's like held up. Where is XLP? I really love staples because month of September, it's still positive. It's the only thing that's still positive and things that I trade because I don't trade real estate stocks like that. So XLP is the only thing that's positive and has been positive over the last month. So I'm still looking at XLP for a trade. I had a big $2,000 Pepsi trade over the last week or so. Am I still in that? I think I'm still in one leg of that. One contract I have left, but it's up $2,000. I had a big Coke trade before that. I lost on a Coca-Cola trade last week, but that was maybe a $300 loss versus a $1,200, $1,400 win that I had previously, and a $2,000 Pepsi trade. So sugar water has been doing really good over the last couple of weeks. So I think I like staples the most. Financials, like I said, I'm kind of scared off by that because of my trade last week. I shouldn't be, but I like staples. I have a trade on XLY right now. XLY is mostly Tesla and Amazon. I got it on a pullback, but I'm close to my stop. We'll see where that is on Monday, whether I can get stopped out of that or if it pops up. Tesla had a really bad day on Friday. So I even got it past one of the mean reversions, well past where I typically trade, and it still went down a little further. So I'm hoping it's exhausted and pops on Monday. If not, I'm going to be stopped out of there. But those are probably the couple of paces, and then maybe healthcare too. I've been trying to get a Johnson & Johnson swing on, but it hasn't pulled back enough. That's the name that I'm really looking at in healthcare. Those are probably the only three sectors right now that I'm really interested in trading. Would be consumer staples, XLY, and XLV. Like I said, XLU has been pulling back a little bit more than I expected over this September too. But those are probably the top three. XLP. So if we start going to go look at what's inside of those ETFs, you can always go look this up. I know them by heart because I just trade a lot of the names. So like Procter and Gamble, right? That's a name. It looks like it's been trending up too. So I want that on a pullback potentially next week. Walmart is in XLP. Walmart looks like it's consolidating. I don't know so much. The trend isn't as strong. And so also when I'm talking about trend, what I'm looking at is these moving averages. What I want to see is it coming from the bottom left up to the right. That's telling me that it's in a trend up. If these moving averages are going down, that's telling me it's in a trend down. So I'm looking for pullbacks on upward trends. So Walmart has an upward trend, but if you look at PG's recent upward trend, it's a little bit stronger. Not so much, just the last few days, right? So I'm looking for strong upward trends, right? So Walmart looks like it's flattening out a little bit. So you can go to Costco. That's in XLP2. That's flat, so I probably wouldn't want to trade that. But if we look at Pepsi, that's what I traded this week. This is where I made that $2,000 is on this big candle right here. I got in on this day right down here and got almost all of this, right? Where I think I took 12 contracts or something like that and got almost all of this move. Probably got out here a little bit, got out a little bit here, and then sold everything I think except for one of my contracts right here, and I think I got one left, right? Scaled out, but that was like a $2,000 win on that trade. It was Coca-Cola. Look at that trend. That's the strongest trend, which is why I tried a second time to get in here, but we kept going down and I got stopped out. But I still like potentially a pullback maybe to a moving average on Coca-Cola. as well. What else do we have in XLP? So we did Procter and Gamble, we did Walmart, Costco, Coca-Cola, Colgate. It's another one. I like that trend too. So maybe a pullback on Colgate would work as well. So that's pretty much XLP. If you know what, let's go do that exercise one more time. If you are looking to figure out, like, right, so I'm showing you on Koifin, this is a free tool to figure out what sectors are performing well, and I like to take pullbacks on the best performing sectors. But if you want to go figure out what's in XLP, all you got to do is go Google XLP holdings, right? Go find what's inside of it. And then the weight, right, is extremely important. So in XLP, I know, and I kind of went through them. Procter and Gamble's the heaviest weighted, Costco second, Walmart third, Coca-Cola. I don't really trade Philip Morris, but then we got Pepsi, Colgate, Target in there, right? Some of the names. You got some of these other names as well to kind of look at because, and what I'm also looking for is I want to see, does the stock look like the sector? So is it trading like the sector? So if we're looking at XLP and it's going up, I want to go find stocks that look like this so that I know that it's tracking the sector or the index, right? So some of the names we just went, they kind of look like that. It's trending upwards still, and it looks like this is kind of consolidating, but this is literally the only sector that was up last week. So this is where the only strength was, unless maybe you're trading commodities. The only strength has been in XLP. So that's what I'm looking at. And then what else did we say? We said XLY. XLY is heavily dominated by Tesla. I don't know why these drawings look like that. Dominated by Tesla, but they had that big red candle on Friday, which is what took down all of XLY, and Amazon. Those are the two main weighted names, and we had a big candle down on Amazon too on Friday, right? And you'll see those track XLY. Big candle down on XLY because the two heaviest weighted names in XLY were down. But this has been a stronger trend over the last 30 days. So if I were prioritizing trades that I'm going to take next week, I would prefer to be trading things that are inside the XLP. Secondarily, I would probably trade the XLY itself. Like I said, I'm almost certain I'm in an XLY position right now, but I'm close to being stopped out of there because I'm right around my 25% stop loss, right? So XLY is number 2 where I'm looking for strength. So either XLY itself or Tesla or Amazon pulling back to a decent level if they're in trend. And then number 3 is healthcare, so XLV. But I specifically like Johnson & Johnson because it's been the strongest name that I have seen in XLV. You see, I already have alerts there. This thing just hasn't been hitting my levels recently, right? So it hasn't pulled back enough for me to buy it at the levels that I was looking at. But I'm looking at J&J. Let's see what UNH looks like. UNH looks pretty good too. AbbVie. No, I don't really like that. Looks like it's consolidating. The trend looks like it's losing the trend because it's pretty flat. You see these moving averages flattening out. And then Lilly, which is, nope, Lilly lost the trend too. So if I'm going to healthcare next week, I'm either going to trade the whole sector in XLV. If it's liquid in the options, I would really like a Johnson & Johnson pullback. I haven't been getting it to the level that I wanted it. And no, I think J&J and UNH are probably the only 2 that I would think about taking from a healthcare perspective next week. And that's really it. That's all I really got for y'all today. Y'all got some questions or any stocks you want to look over?
Let's look at Amazon.
All right, if we look at Amazon right now, I have a alert here at 156.50 as my price that I would like to get into Amazon at. And I'm fully vested in my retirement funds. I put the full amount, the max amount of my IRA and my wife's IRA every year. And I'm kind of in the positions that I want. I bought some ELF. That went down a little further than I expected, but I still got it at a discount as far as I'm concerned. I want to hold that for 5, 10 years, 5 or 10 years regardless. So I think I got it at a level that wasn't anywhere near an all-time high, but I might move some more money over to get in some more of these positions if we hit some of these lows in September specifically, for two reasons. So just in terms of like my allocation of cash and assets, I've been doing, like, I would say 30% is in my businesses, like in my law firm, in my bookstore, where in terms of like my asset allocation. And then I would say there's probably like another third in stocks right now, meaning like my IRA accounts, my kids' accounts, things like that I've been trading. Um, maybe should I say 30? Maybe like 25 to 30. And then I would say I have another 25 to 30% in a high yield interest account right now. And I've been safe, so I've been parking some cash on the sideline for at least the last year and a half, because since interest rates have been up, I've been getting 5% parking my money in a high yield account, and it's relatively safe. So especially if you have less than the FDIC insured amount in there, and so I'll probably do that with separate accounts in different banks to make sure that in case a bank goes down, that it's federally insured. I've been putting money in a high yield interest account, and I've been getting like $650 a month off of that over the last year. So I've been having some money in there, but what I'm afraid of is as interest rates come down, I'm not going to be getting that 5% anymore. It's going to turn into 4% or 3.5%. And then for me, that's not enough alpha on my money. So I'm thinking about moving some more money from the high yield interest account over back into my stock account, into my trading accounts, uh, because I could probably get some more alpha out of that, even if I invested in something safer like QQQ or SPY or an Amazon when it comes down to 156, something like that, to take advantage of some of these positions, because I'm not going to be getting enough yield in a high yield interest account as interest rates come down. So I might shift my cash back to the stock market, especially if we're getting some of these pullbacks like this. So I might just bring some more cash online, buy some more of these stocks at these lows in September. I'm actually thinking about doing that next week, because I'm waiting for some of these lower levels to trigger, like Amazon, or Nvidia. I might buy some more shares if we get back down to $95, right? I really wanted at like 90, but I'll start looking potentially to buy some more Nvidia shares down here, just because this is a company I believe in long term. Next 5 or 10 years, yes, we might dip a little bit lower, but if you plan on holding it for 5 or 10 years and not selling, then who cares? Because if you zoom out 5 years ago, look at where we were to where we are now. All of this is just noise. Look at AMD 5 years ago. I kind of want some AMD if we get down to 121, 120. That's another entry point for me. So that's what I'm saying. I got a bunch of chip stocks though, so I don't know if I want to load up on a bunch of chip stocks. If I did do that, it'd probably be better for me to just buy the ETF if we get back down here to this 200, 201, 202 level, right, on SMH. But like I said, we going back to Amazon. That's the price that I like, is 156.50. You could potentially see it bounce right here because it's hitting this 200-day moving average. The reason why I'm a little bit more concerned is because it's already dropped below that. So I would love to get it around this low here where it was previously, and this was this August low if we have a pullback. But, it might pop right here at that 200-day, which is where I like to buy a lot of stuff too. So if I bought it here, I would keep a tighter stop on it. If I buy it here, I'd be less worried because you're getting it with a 40% discount here rather than here. It's more like a 20% discount, 25% discount, you know. So that's kind of my what I'm looking at on Amazon. And then always zoom out. Go look at the monthly chart. Go figure out where the levels are on the month, right? So that's why, like I said, my level's right around here, right around this low. That's where ideally I would buy it, but I love fib levels too. And the fib levels around 155.40, 155.50. That's when I would probably try to enter and then put a stop maybe right below this low right here if I were swing trading this. If I'm holding it long term, I still think this is a good place to enter. Ideally, it's close to this low. But the reason why I grab it a little higher is because I don't want to miss out on a particular trade because it pops right here at a fib level, which is a level that it tends to pop, or at this 21-month moving average. So that's kind of my level right there on Amazon. You got anything else? Mamba, hush. Anything else you want to look at? Guys, anything else you want to look at?
I believe Isaac wanted to look at Tesla.
Tesla?
Yeah.
I've been staying away from Tesla. So, once again, like I said, let's zoom out. We're on a month chart right now. Right? So, if this is a month chart since like January of 2023, what has Tesla been doing? Isaac, are you on? Or are you working? Or DeAndre, this is an exercise of like technical analysis.
Okay.
Since January of 2023, where has Tesla gone?
Looks like it's going sideways.
Yeah, that's sideways. That's my assessment of it. And I told you, I get they have the humanoid thing. I don't believe Elon's gonna even put everything into this company. Who's to say that he doesn't develop another company for his humanoids and then make that the thing and it's another vehicle like he did? It'd be different if SpaceX was inside of Tesla, or what's the internet company he has? Starlink. It'd be different if Starlink was inside of Tesla. He's building all of these things outside of Tesla, and they're their own billion-dollar entities. But I would feel a lot better about Tesla if Elon was building those things inside of Tesla. And he's not. So as far as I'm concerned, it's a car company. I mean, and I own a Tesla. I love the cars, but I'm thinking about getting rid of mine at the end of the year. Not because I don't like the car, but just to save money, especially if we potentially head into a recession or something, right? So, I love the cars. I love their business model because it's like you order before they make the car. So versus like the old school model is produce a bunch of cars, sell them on a lot. Some things sell, some don't. Like Tesla doesn't make your car until it's actually sold it. So it's a way better business model, but it's still a car company, and the multiples on earnings don't really make sense for me, right? That's just me, and I'm just looking at the stock price. I don't like this. The high was back in November of 21, right? And where are we now in 2024? And it's just been going sideways. So from a long-term standpoint, Tesla is not in my long-term portfolio. I don't even intend on it being there. I think there are a lot more companies out there. My top 20 that I named, that I gave y'all a few weeks ago, Tesla was not inside, that I think are better and a better position, have a better moat in the future than Tesla does at this point. Now, if the robots and things pan out, then I'll give Tesla another look. But Tesla's been kind of going up and sideways recently. It's really volatile. So for a swing, if you catch it at the right point, it's really good for a swing. But you got to get in and out at the right time. I would even scalp Tesla probably more than I would swing it, just because of how volatile. It's like red candle, green candle, red candle, green candle, red candle. Like it's not showing me it has any direction. If you look at the moving averages, they're all flat. Remember what I was just saying? You want to see them trending up like that. All the moving averages are flat. So Tesla sideways. So it's hard to get. So it's choppy. It's hard to get alpha. I want a trend. I want a downtrend or I want an uptrend. I don't care where it's trending. I want to see all of these lines going straight down. Then it's easier to swing this to the downside or day trade it to the downside. Or I want to see all of these things moving up because then it's easier to swing it to the upside on the pullback, right? So like for me, I stay away from the chop. Like it's hard to win in this up and down consistently. I want to see like I saw on Pepsi, like that big candle right there. That's what I want to see. And Tesla's not giving me any of that. It's just giving me chop. So I don't know. I'm trying to stay away from Tesla personally. Long term and even from a swing basis right now. And I would rather swing XLY where Tesla is a big component because this is way more stable than Tesla itself, you know. But XLY has more than Tesla in it. It has Amazon and a couple of other things too. Amazon and Tesla are the highest weighted, but if I wanted to swing Tesla, I would rather swing XLY. And yeah, this just looks like chop to me. That 200 moving average is flat. I never want to trade a moving average that's flat. I want to see this going up or I want to see it going down. All right. Anything else you want to look at?
That's it for me.
All right. That's it for this week. Mokama Sunday service, making it rain without the umbrellas. Once again, if you want to be on the Zoom, message me, DM me, leave a comment, and I will shoot you the Zoom link for next week. But we do this at 8 a.m. every Sunday. Just us going over stocks, going over the market so that you can better understand what's happening. So ideally, you feel more confident investing because you actually understand what's happening in the market. But yeah. All right, gents. Next week. Shout out to the family. Hope everybody good.
All right, bro.
All right.
Take care.
Peace.